Hey everyone, Brian Bodner and Greg Towner here with Parallel Portfolios, and it's time for our April 5-minute update. So let's go ahead and get started here. Greg, where are we at right now when it comes to stocks?
Yeah, thanks, Brian. Well, believe it or not, we're actually price-wise, and we look at the S&P 500 at almost the exact same point we were when we did our video a month ago. There's obviously been quite a bit of market movement since that period, both down and up, but lo and behold, we're back to about the same level. So, when we look at the market, we still think we're in a pretty constructive longer-term price trend. Certainly, there's been a lot of increased volatility this year. But we think, we're going to show some evidence here, but we think a lot of things point towards we're still in our base case of a correction and not a worsening bear market.
Well, how long do you think this correction is going to last?
Yeah, this next chart is actually an interesting thing that helps deal with that. This looks at, worldwide stock markets and historically when they've peaked, how long it took and how far they had to go down during corrections or bear markets. So the green line is this current period. We can see that based on history, we're about at the same time period and about at the same percent decline as so-called normal corrections, to the extent anything can be normal. So that helps add to our base case that we think we're right kind of in that ballpark of where we should be bottoming, and some of our other factors look that way as well. Certainly if we went into a bear market, things would certainly be much worse. But let's look at a few examples of why we think we are just in a correction mode here. All right, so the first one, and there's a lot of different factors we can show. We'll just deal with 2 or 3 today. So this is the advanced decline line. The blue line is the S&P 500, like we just looked at. But the yellow line is the New York Stock Exchange advanced decline line. So it basically looks at the advancing stocks divided by the declining stocks. You want to see that this is at least confirming what the stock market is doing. And in this case, it's actually giving us what we might call a positive divergence. So it's actually better than stock. So kind of the internal breadth, so to speak, of the market is really confirming and showing us that the internals are healthy right now.
Okay.
And then if we look at a little bit more of a fundamental perspective, so this is earnings estimates on the S&P 500 looking out for the year. And usually what you see is when you come into the year, analysts are a little too bullish, and then as the first few months of the year goes on, they have to ratchet back their expectations. All those blue bars on the downside are past years when they've done that. And we look at this year, they've actually had to really ratchet up their earnings expectations due to, of course, the tax cuts, but also that they were not expecting such broad economic growth throughout the world and strong earnings from corporations. So tying this back to the correction of being our base case is usually bear markets happen in or around recessions, and recessions usually happen when the earnings scenario is weakening, and that's just not what we're seeing. So obviously you can never completely rule out a correction getting worse than that, but our work right now is showing that has a lower likelihood.
Okay, good stuff. Well, you've been talking a lot about stocks. Is there any other areas that look interesting right now?
Yeah, actually there is. We've talked about commodities a little bit over recent months, but not nearly to the extent of some other topics. We thought it would be a good time to show a longer-term chart. It's about a 4-year chart of a broad commodity index. Obviously, it was in a terrible bear market for quite a while there. Spent the last, a year and a half plus kind of basing out. And now here in recent weeks and months, we see the commodity indexes start to gain momentum. And you can talk about a lot of potential reasons to talk around tariffs or so forth. But really, we look at the potential for inflation increasing, that is tied with rates increasing. You could just look at a lot of the commodities, maybe have tight supply, and then just natural rotation. I mean, this is a group that's been out of favor with a lot of people, as we say, underweighted. So people are maybe starting to gain exposure. And this is certainly an area in the last really few months that we've started to look for areas to gain exposure. We've added a little bit to energy. We've added a little bit to metals and mining. We're going to continue to look for areas to selectively buy here. I mean, we know that commodities are historically very cyclical, so you have to be careful and focus on the higher quality ones. Right. Definitely an area worth paying attention to for a lot of reasons.
And with interest rates moving higher too, we talk about higher inflation, hard assets tend to sometimes do well in those environments too.
That's right, exactly.
So in summary, what I hear you saying is that stocks are still in long-term positive trends, even though we've been, spent the last couple months here correcting, but we're kind of getting to the end of that correction. Everything's kind of been online with what we've seen historically. We're getting to the end of that. The positives is the market internals, or what we like to call the breadth of the market, still looks strong. Corporate earnings are still strong. So we're not giving up on stocks yet. And commodities are catching a bid here and potentially looking to move higher. So we're seeing some interesting things happening there. Well, as always, Greg, always appreciate your insight. If any of you have questions, you can give us a call here at the number on the screen, shoot Greg an email, and we'll be happy to answer them. As always, thanks again, and have a great day.